I'm Chris Milner, and I am the founder and the CEO of OAKLEAF Group. We're a DC-based mortgage industry consulting firm. And I'm stepping in as moderator today. John Levinick, who was originally scheduled to moderate this panel, fell ill. Unfortunately, he's had the flu, and he's on the mend, but wasn't able to be here today. So we had a quick change in roles. We have an excellent panel for you today. You'll see the panel are all practitioners who are actively engaged in helping advance analytics in our industry. And so what I'm going to do is we'll do a quick introduction of the panel. Then I'm going to do a quick introduction of who all's in the room here today, just a survey, so we kind of can get a sense of what kind of firms are represented in the room here today, and then we're basically going to talk about our views of the current state of artificial intelligence and machine learning adoption in our industry. We're going to talk about what we see as some of the adoption challenges, and then we'll close with a little bit of prognostication about where we see the impact of these technologies in our industry. And of course, the more interaction and questions that we can get from you, the better. So please feel free to interject and make it a real dialogue as opposed to just a sort of a presentation. So I think I'd like to start by having our panelists introduce themselves. If you could talk a little bit about your current role. I always find it interesting to hear where each of us were in the years after the financial crisis, sort of the 2008 to 2011, 2012 era. That is helpful for me always to kind of set context about what our experience was during that time. So on my immediate right, we have CHAO Chong. Can you introduce yourself, please?
Thanks, John. Good pronunciation for my last name. So, CHAO Chong or CHAO Kong from Black Knight. If you walk on the escalator, probably you see Black Knight logo there with a lot of words there. So the key is Black Knight offers the new thing, what we call the cloud-based virtual data analytics lab. And traditionally, Black Knight is known to provide data, mortgage market data, public record data, multi-listing data, all sorts of data I can think about in this space. For me personally, educational background, I graduated from University of California in San Diego, the economics PhD program. But before I passed my dissertation, I left the school and went to get my credentials in CFA and FRM. Back to the crisis period, I was in Washington Mutual, no longer exists, and then went to Chase, and around 2009 went to CoreLogic. I stayed there for a really long time for working in the modeling space mainly, and later I switched to product management, also analytical solutions, including like models and the home price indexes. It's very well known. And in Black Knight, I do manage a similar set of solutions, prepayment credit models, default scoring for servicers, and the home price index, listing index, just all sorts of analytics offered by Black Knight, the data and analytics division.
Great. Thank you. Hi, everybody. I'm Janet Joswick. I'm a managing director at Riskspan. We're a data analytics technology firm in the space. My role is kind of divided between the two halves of our firm. We have a software product geared towards investors to help make trading decisions and analytical decisions better, and consulting services. So we kind of touch on machine learning and kind of both of those aspects. During the crisis, I was at Fannie Mae. I worked on credit risk pricing, so it was actually kind of a pretty interesting role and job during that time. So if you all are familiar with the LLPA matrix, that is what I was working on. in '08, in '09, in 2010. So if you don't like it, then yeah, that's what I was working on, so sorry.
Hi, my name is Lester Firstenberger. I'm CEO of VEPTAS and iCurio. We've developed the first deep learning artificial neural net for mortgages, resi mortgage. It produces a 96% accuracy on a confusion matrix. That means true positive and true negatives for all cash flows, prepayments, and defaults. I'm a lawyer by training. I've securitized over $1 trillion. I was the chief regulatory counsel at Clayton. During the crash and after, I was at Clayton first, and then I was at Huron Consulting, where we were building an earlier version of this model.
Hi, I'm Matt Wong. I run a company called Liquidity. We're a software company, and we automate the task of moving data between applications. So we are an unbiased party to help you to analyze your data and connect it to other people's models, other people's valuation services, help you to just get data in and out of your organization and through all the applications that you need to analyze it. Pre-crisis, I was an investment banker at JP Morgan. I was a lead banker on all of our prime and Alt-A deals. You may know their JPMNT shelf that they're still issuing off of. I closed 50-something securitizations of JPMNT and JP Alt, did their first post-crisis 2013 transaction as well, and established the rep and warranty framework that they still continue to use for that today. During the crisis, I was involved in a number of valuation projects for banks that we were acquiring or banks that we were advising funds to acquire, and help the firm with its various legal-related litigation matters when we got sued on every single deal up in existence for Bear Stearns, JP Morgan, Chase, WAMU, and everything else. Started this company because after being at JP and doing a lot of work related to loans and securitized products for a decade, it seemed to me like our biggest problem that I saw from my seat as a banker, as well as that I saw my clients and other constituents we worked with having, was the ability to just get data from where it was into where they needed it to be.
Great, thank you. If I may, what I'd like to do is just a quick survey of the room so we can kind of get a sense of who all is here. So if you wouldn't mind, if you're investor or buy side, if you'd raise your hand. And, okay. And what about originator or lender? Okay, good's mattering. What about servicing or master servicing or collateral management? A couple? Okay. Law firms? Couple?
You.
And what about, and then if you, let's see, if you didn't raise your hand, could you raise your hand and just, can you tell me where you're, what aspect of, what, it's like regulator? Okay, any other regulators? A couple of regulators, good. And then anybody else didn't raise their hand? Can you, pardon me? Underwriter, okay, yeah. So, from a securitization perspective, sponsor? Okay, good. Anybody else? A compliance technology, okay. Anybody else? Great, okay, thank you.
Can we have one more question? Yeah. Like in this room, who is currently using machine learning? 1,
that's a good
2,
question.
3, 4, okay, 5, 6.
Yeah, if you're,
oh, actually, it's pretty good. Yeah. And who else is considering to think about that if it's not using right now? Okay. So together, almost half. That's pretty good.
Yeah, so together, certainly more than half either are using or considering using. Yeah, so
That's nice.
it's happening. Great. What I thought we would do is start with just a description from each of our panelists about where, in their, from their perspective, we see artificial intelligence and machine learning being deployed currently in production, or where we see it being evaluated, or an experimental or a sort of under consideration, and then after that we'll get to some of the implementation considerations. So, Matt, would you start?
Sure. So I think some of the places, obviously, in underwriting criteria, there's a lot of, you take the idea of today you can go to a website, and if you're buying a plane ticket, you can click on a button and someone will underwrite your, finance your trip. Someone was just telling me about that today. I haven't done it myself. But there really is no reason why there isn't going to, at some point, be a similar experience if you go to an open house. But in order to get there, a few things need to get in place, and I think that's where people are today, is getting to the stage where they're just getting aware of what they could potentially do with this information. We see portfolio managers, asset managers who are just starting to become much more open-minded about alternative data sets and about the possibility of incorporating them into their platforms, and seeing that one of the ways that they can do that efficiently and start to quickly assess the value, at least preliminarily, is through the use of machine learning technologies, which really are an extension of what they already used to be able to do, but they can do it in a more scalable manner, a more flexible manner than they could before, just using straight Excel linear regression.
Thank you. Lester?
So
Certainly got a different perspective.
well, mine's more mortgage-centric, but it applies across the board to all asset classes. There's the front-end origination, then there's the back-end surveillance. That surveillance can be by the investor, by the owner, by the servicer, and each of them have different constraints. As we all know, a lot of our peers still use Excel spreadsheets to do a lot of their analysis, and that's common and ubiquitous, and it's what they've done for 5, 10, 15, 20 years. This technology that's coming forward is going to allow much deeper analytics to occur. So 5 years ago, big data was what we're all talking about. Now big data has facilitated machine learning. And so this deep learning aspects that is giving confidence intervals that are way beyond what exists today, that's the future. And how it gets used by an investor, they have more perfect information than their servicer. They beat their servicer up over the head with that and say, fix my prepays. The servicer is going to say, yeah, okay, I'll do that. And so that base knowledge that everyone has is about to change, is my thoughts.
So I guess in terms of where I have seen this be used and where I'm starting to see it be used, I kind of group the use cases into cost-saving use cases or operational efficiency use cases, and then like revenue-driving use cases. So just with our clients and our platform, I think over the last 2 to 5 years, it's really been more on that operational efficiency, because I think that's where you can easily make a case for using these techniques. So things like even data normalizations, which I think Matt can probably speak to a lot more, using these techniques, are just automation of processes that were manual, and there's still a lot of room in our industry to have those applications happen. But where I see kind of things going, or a bit more of these projects in production coming, is more on the revenue driving side, and where we have a lot of connection is the investor community just making better decisions quicker decisions around investment opportunities in the space, being able to pull together different data sources from, not just, what is the collateral, what is the structure, what does it do under these scenarios, but also what, this new bond that's coming to market, how does it look like an older bond that, I priced a few weeks ago, and you can use some of these machine learning and classification techniques to help facilitate that. So kind of more where I kind of see, today's world is kind of focused more on that, how do I make more money with these techniques?
So I think I kind of hold similar opinion as Janet. It is a trend in this industry, but I still feel there may be some limitations to penetrate to all areas. Everybody wants cost effectiveness, efficiencies, and from modeling perspective, accuracy. But there are limited areas. Some of those which is more like operational heavy, like in origination technology, probably right now a lot of AI actually is going on, especially in Black Knight. There are some fantastic AI technologies already implemented. I have no questions on that end. And for machine learning perspective, yes, for modeling, there is always constant discussions for going on for a while. Like I offer similar models as Lester, almost competing models, how my model perform as compared to his model. So I would say there are merits in traditional models which based on some sort of different methodologies, based economic and financing theory-driven models built on also big data and some very robust framework over the last 20, 30 years, as compared to something only 2 to 3 years. How do you think the robustness? So, and on the other end, actually, for no matter what is the underlying element for any this machine learning, you have to go back to the data. So the big data has been in discussion for a long time, but still we're discussing it as today. That's an example, right? It's not a quick adoption process. So that's why you do need something to leverage to jump into this. That is more like a big data platform. So I would say what's the big data platform, like you walk on the escalator, you saw that virtual analytics platform, that is something actually help the industry to adapt, to speed up on this process.
Thank you. As we were preparing for this panel, all of the conversations that we had about getting ready to implement or either buy or build artificial intelligence or machine learning or robotic process automation, all those conversations kept coming back to the data readiness around it. And the model, any model is only as good as the data that is going into it, and the newer machine learning and artificial intelligence models in particular, especially when deployed on the cloud where there's a lot of computing capacity available to them, they are able to digest more data and more disparate types of data than more easily and more readily. And so, it was hard for us as a panel to think about artificial intelligence and machine learning separate from thinking about data readiness and data maturity. And so I thought it would be helpful to just talk a little bit about where we see the adoption challenges, and in particular the data aspect of the adoption challenge, and where we see from each of our perspective the industry moving to kind of get ready for AI and ML by modernizing data. So, Matt, if you wouldn't mind talking a little bit about that.
Sure. Yeah. So I think I would liken the industry, with certain exceptions, but in a lot of cases, it's kind of like a car. And there are a lot of moving parts, and, you know, the steering wheel doesn't work by itself. You've got to have an engine, you got to have tires, all that stuff, and none of it works unless all of it works. And I think that a lot of the new technologies right now are kind of like a new engine that can go a lot faster. But our cars are currently outfitted, in many cases, they've got tires that are not meant to go more than 30 miles an hour. And so I think where I see a lot of the industry today in terms of data readiness is that they're not ready for that high-performance engine just yet. But I think that they're along the path where we're certainly further than where we were a few years ago in terms of awareness. We're beyond the awareness stage. Most of the folks that I'm aware of are at least in the stage of evaluating how do we buy these new tires that'll get us up to 200 miles an hour so that we can then get that new engine. They might be somewhere in the stage of actually executing on that. I think where we don't see people yet is actually being able to try out that new shiny engine, and I think that once they do get to that state, it's going to require a lot of iteration, a lot of trial and error before they actually get something that, because every time you have a new technology, you really need to iterate a lot to be able to get value out of it. The first time you do it, it's probably not going to yield any meaningful results until you've gone through it several times. And you can't go through it several times if all of the pieces that are required in order to use it at all are not yet lined up. So I would say data readiness is similar. You have processes that are still very manual. They need to be made more efficient because there's no way you can process a lot of data without those processes being more efficient. In order to be more efficient, there's a humongous value in being able to move to the cloud, but a lot of institutions aren't yet ready to move to the cloud, or maybe have just gotten ready from a legal and compliance standpoint, but are not yet ready in an operational standpoint. So I think data readiness is very, very highly related to this topic in a practical sense, even though from sort of a theoretical or from a sense of how it all should come together, it really is not a direct relation.
So I'll give two examples. There's big data normalization. So to build our deep learning neural net, we took, well, now the version is 130 million loans, 7 billion payment records over 23 years. It was 11 or 12 terabytes. We had to process that on the cloud with 16,000 processors. Took 52 hours the first time. Model converges. That's one version of that big data normalization. First time our data scientist, chief data scientist, normalized that data, it took him 4 years and 7 people. He's down to about 9 months now to be able to do it because he's done it so many times. That's one aspect of it. When you start playing with these big data sets that you're going to build algos from, it's very, very difficult and very time consuming and difficult. Once you have that output and you've created an algorithm that you can use that is your output for your machine learning, your deep learning, we run it on a server. I'll take 1 million loans and I can turn it around in 2.5, 3 hours and put the outputs of all of this. So Matt's exactly right. Most of the institutions are not ready for this, and so we don't expect them to. We take, and I think, you know, Matt's service, we take it as a core competency. We have to do the ETL, extraction, transformation, load of the data, or we can't run our models. So you need that core competency, and it's, I don't know, 80, 90% of the work that we do is that ETL data normalization. The algos are the easy part.
Yeah, I guess just in terms of what I've seen at originators and servicers who are a lot of our clients, it's all over the map. Some people, their data systems are pretty mature and probably could easily feed data sets to your downstream system, our downstream system. But then, you know, I work with pretty large servicers who barely even have data structures in a SQL Server database. Like, there's no primary keys connecting their data sources. So it's just like, how are these firms ever going to use any of this if they can't even create a data tape? So I do think the industry is kind of all over the place with this, and there's going to be people who can easily adopt these techniques today and have been, and then there are folks that are going to be left behind unless they put some investment into their data infrastructure. because, to Matt's analogy about the cars, if you don't have those tires or you don't have the raw inputs to these models, they're worthless. So I think there's probably a reckoning for some folks in our industry around their data quality and data hygiene.
Yes, so I'm with everybody. Data readiness is really the most fundamental piece of this industry revolutionary change. Actually, traditionally, do we have those data? We do. Like, for example, everybody knows mortgage data, mortgage servicing data, and public record data, which you can find your own name, your address, and all the property record information in most of disclosure states. But right now, actually, you can do much more beyond what these are two different single pieces of data, but instead, the servicer can actually just link my mortgage, my borrowers with the information in public record data. Actually, what service can identify, I lost this 50% of borrowers in the last 6 months. Whom I lost to? Wells Fargo lost to top 5 servicers, Chase, Loan Depot, or Nation Star, or whoever. So all those kind of analysis, you can actually do much more based on today's big data platform.
Yeah, thank you. I would just add, from my perspective, working with large financial institutions and the GSEs in particular, there's it's always surprising how much effort and how much expense is involved in getting data ready to deploy new models. It's much more expensive to modernize data infrastructures and to replumb data flows in a large organization and to kind of get the data staged than it is to deploy data scientists and new technologies and new model types. I'm just curious to hear the panel's view on the relative level of effort behind the data readiness and then the model deployment itself. Because certainly in my experience, the data readiness is underestimated, how much of an effort that is, and it always comes as an unpleasant surprise about how many man-years need to go into getting the data ready to really leverage it with these new models. Matt, would you have anything to add to that?
Yeah, it's hard for me to not talk about my company here. So if when we work with a customer who's, for example, last year one of our asset manager customers was considering using a different pricing model or augmenting their existing process so that they have multiple models. And to do that takes at least a month just to do a test case with some of the data that they already have, because they've got to get an analyst who knows the test case that they're going to use and is very well knows exactly what their pricing is that they expect it's going to be, pour through all the documentation of the new model, be able to convert the data into the way the new model wants it to be, and be able to then figure out how to get the data into the model, how to get the data out of the model, what the data that comes out of the model represents, and then how to put that aggregate that into a report in a way that's sort of going to make sense to their traders or whoever else is looking at that. And that's just for one test case. To put that in production is another several months. And when I say production, I really don't yet mean that they're putting money on the line yet. It's more just a production level of scale to be able to put data through it at that scale to then be able to assess the value. So there's a multiplying effect when it comes to not just the data that you're looking at, but the different formats of tapes and the number of columns involved and the amount of sort of manual touches that people need to do. So in our experience, it's probably skewed away from the average because that's where we do most of our business also. In our experience, it's not just 80 to 90%. It's more like 99% of the work. Once the pipes are set up, once the automation is set up, click a button and you're good to go. But there's a huge amount of work to get that done, and without specialized software, that level of automation never occurs. And then best case, you're getting to 3 to 5 days of manual work to put it through the pipes once.
We go at it a little bit different way. So knowing that that problem exists, Matt's described it very accurately, we chose to avoid that problem. And the way we avoided it was creating the neural net. And once you create a model, and it's not going to do everything. You can't use it for all analytics, but it does a lot, and it'll predict a lot. I only need 100 data elements from the asset owner, servicer, to run my model on each loan. So there's a number of ways to skin this cat. So we didn't want to boil the ocean. We boiled the ocean in the creating of the algorithm. But then when it actually is to running the model on the individual loan level, I need 89 data elements. Plus then we have external economic forces we forecast. So it's just, there's going to be a number of ways that as the trade matures in using these types of technology, that data normalization is going to occur, very specific use cases. My use case won't work for credit card, but a version of this like for credit card will occur. And it will be helping the institutions see how data normalization can make their processes, origination, servicing, secondary, whatever it is, much more efficient.
But just to add to that, but if someone wanted, so that works for generating your model, but if you then want someone else to use that model with their data, then there's still that friction of figuring out how to get those 80, 90 data points that are in their systems into your model for it to be
Absolutely. It's typically a 2-month process. We still run the models. We just have to normalize the data. So they'll give us whether it's 150,000 loans or 2 million loans, they give us that. We normalize it. And then there's probably, you're right, 500 touches back and forth with our various data people talking to set up, and then it flows from there generally with minimal touches. But that's a very standard process for us.
Janet, when you talk about this, if you could also, we've talked a little bit in preparation for the panel. If you could also talk a little bit about how a business process owner thinks about the ROI, because it seems like there's a lot of upfront investment of modernizing data that may or may not have sort of current tangible benefits.
Right.
And so also if you could just talk about how you think a business process owner should think about or assess these infrastructure investments along the way.
Yeah, sure. So, in my mind, that a big kind of hurdle to adoption of some of this is how do you prove it's actually going to give you a return on investment? Okay, so my model, my credit model is a little better. Like, who cares? Like, how does that put money in my pocket? Does that actually matter to me in any way? So I think the way kind of we approach it is just sort of incrementally, to take a look at, okay, what are some areas where we can either, like I said, cost reduction, or we can have some sort of competitive advantage in our investment space and have better returns. Let's do a small scale project, prove out the idea, and then iterate on it to bring it to production. I think, Matt, you had mentioned, like, these ideas, they take iteration. You're not going to get things right or see, clear value on the first time, but you kind of have to keep working at it. But if you can set up very thoughtfully, your investment initially being small on a sort of prove out the idea and then move on to more production level implementations that might involve more large scale investments into your data infrastructure to support it. I think that's probably the incremental way to go and the way to sort of prove these technologies out to your management teams who might be kind of skeptical of it. But in general, these technologies are coming, and there's reasons to make these infrastructure improvements that aren't related to machine learning or other reasons. There are compliance reasons and data governance reasons to make these same investments that would bear fruit for these technologies as well.
Good, thank you. Anything to add, CHAO?
Yeah, I would say, given or considering the huge upfront investment, probably the right way just to go to Black Knight for some big data platforms. I don't know what else to add. You have the data there, you have the platform, it's cloud-based, it's free for all different type of capacity you request, and also you can build all your own queries there. All different languages is supported there, like R and Stella, Python, and it's just a really cool platform.
Cool platform. I'm curious if there's if this conversation of sort of investment in infrastructure, sort of to be ready for modern technologies, if that is evoking any comments or questions or reactions from the audience that we might respond to. I'm sure that everyone is living a certain version of this data evolution and the expense involved with data evolution. I'm just curious if anybody has any observations or questions for the panel on this topic. No. Okay. All right. Yes. Yeah. Thank you.
Last question, maybe later. So one of the things that we've been talking about at our institution, not coming from the mortgage capital market side, thank you. I'm coming from the mortgage capital market side, so Fannie Mae LLPAs are a big part of our life. I was very surprised to hear you're working on that. One of the things that I've struggled with over the years is we have on the front end Fannie Mae LLPAs, and the industry pretty much prices to those. As you go through the origination process, close a loan, and the loan ends up, say, in a security somewhere down the road, whether it's issued by our institution, another institution, whomever, or in any number of the cohorts, they're looking at those individual loans, and they're pricing out the risk and to the baseline of that security. As we've been having conversations internally on machine learning, which we currently use due to our credit card issuance and other portions of the areas of the bank, now we're transitioning that conversation into mortgage. One of the things that has been tickling the back of my brain is using AI and machine learning to not necessarily validate Fannie Mae's loan level price adjustments, which have largely been fairly static for several years, but to accurately price the loan through to the final securitization, because the one thing that we focus on is bleed. You may have the perfect hedge, but if you're not pricing to the final execution, how much are you giving up and how do you get there?
Yeah, so
question or comment? I mean, I'm not really sure what that is.
I have a quick comment on that whenever you're done. No.
yeah, I was going to say, so I have heard about this. There is a need for it's almost like a better, best execution framework where you can pull in market feedback directly into that decision-making process, and you're not going to get that market feedback for a couple of weeks or months. until you execute, right? So it is how to kind of make that a little smoother. I don't know if I have any answers, but I do think some of the process automation can help with that in terms of proving out the LLPA matrix. A hint is that they cross-subsidize, so that there is arbitrage opportunity probably there, but.
There is.
The only thing that I would add is that when you add that securitization layer on top of it, there's you start to get pool level impact, which is hard to measure at the loan level unless you're assuming some pool composition, and you start to add assumptions on top of assumptions when you could and I don't know what the answer is, but I guess what I would say is just be aware that that's going to be a cost in terms of the level of uncertainty in your outcome relative to if you just focused on what your exact loan level takeout is going to be, that you know you've got this exit at the loan level, and focus on the loan, take that same amount of resources and focus on making that model more predictive.
And that's what makes it so difficult for us, is when we get to the point of, well, what assumptions were made, and once you bring assumptions into a model, is it really, how accurate is the model at that point if you're assuming?
Yeah.
Yeah. Thanks.
I just had one follow-up question for you on that. So do you feel like you have the analytic infrastructure, the analytic sort of data sets and tools available to you, so it's really more a question of how should you structure the models, or is it also a question of what other extraneous data could you be bringing in, and how much would it even cost to kind of get that data to your modelers? I'm curious if that's also a challenge for you.
Well, it is, because we don't know what we don't know.
Yeah.
So, it's always the unknown or the assumptions you have to make.
Mm-hmm.
So are you using the right data? Is your data clean? Because you have humans involved in the origination process from start to finish. So you have to question your data constantly, or have your validations in place and your data checks. The second part of that, leveraging the technology to crunch the data and the numbers. There's no, at least in the mortgage side, aside from your hedging analytics that you're using, there's no clear-cut path to the modeling. You're either using or stealing from from the card side or from someone else, and then you're taking a square box and putting it through a round hole. So that's I don't know if that was.
Thank you. Any other comments or questions about? Yes, please.
It's yours. Oh, yeah.
Thank you. I have just one question for the panelists. So sometimes, assuming you have the data ready and you can deploy models, so you go out to advertise your products, and then a potential client can come and say, I'm interested in the machine learning models, but they look like black box to me. I don't know how to explain to my stakeholders on, so that's one of the challenges I have to use your products. So the question for the panelists is, how do you typically address those situations, and how would you explain machine learning models really in layman terms so that people can understand?
CHAO, would you like to start with that?
Okay, so first of all, I have exactly the same question. So in my life, for multiple times, we did like compare and challenger models. So like for one practice, it was the AVM model, just using machine learning technology, different type of decision tree or so on. So I think it was not adopted. It took a while, and the key question is exactly the same. You couldn't explain the model structure, and especially from regulatory perspective, how do you explain to your regulators what is exactly your model documentation, how to do the model validation? And the second time is we also just not long ago did propensity models, exactly the same thing, traditional models versus machine learning model. I think the key question is the same thing, and plus for machine learning model, you really need to have more insights behind the data. It's like, you just cannot purely relying on the data. Like in your model, do you have affordability index? So what is affordability index? The data doesn't have it. You as an analyst and a model will have to derive that affordability index or something like that. So I would say there are a lot of challenges. I will give that to
Janet. I know
Yeah.
you've given a lot of thought to these models and in a regulatory compliance and
Right. Yeah, so
lens.
a big part of my first practice is also in the model validation space. So what we see a lot with some of our banking or originator clients is that they're really trying to wrap their head around, okay, how are we going to get these models validated and through the regulator? And I think half of it is education for the model validation teams and the regulators. And then half of it is, explaining your models and testing your models in new and different ways. I think some of the things to think about are, a focus on the inputs, so more control around what is going into that algorithm, and especially in those underwriting and origination use cases, you have to have tight control over what is going in there. Is it in compliance with fair lending regulations and other regulations? So just way more control over that input to your model. And then to kind of prove out like what is happening in my model, I think a renewed focus on sensitivity testing and output testing for the model in terms of, okay, what happens when, my FICO scores go up and down, and let me just, instead of being able to directly see what like the neural net is doing, you can, indirectly see in the outputs the effects of these variable shifts on the model output. And I think it might take a shift in mindset of regulators and model validators in terms of, okay, what is acceptable in terms of transparency about the model for these models? Because it's going to have to shift. But, I think this input and output focus, something has to change in the way these models are evaluated.
Agree a lot with that. We're going through the validation process now for the front end. So the back end's much easier. Once a loan is closed, the regulations still apply, but it's just a different level of scrutiny and different level of explainability. But, explaining logistic regression to business users, regulators, that was difficult. Explaining true AI and the exponents that come out of there, that's very difficult. And so that for, the front end, the automated underwriting engine that we're using, we haven't deployed it yet because we want that good housekeeping seal of approval so we get the model validated. On the secondary side, and capital markets, managing your portfolio, that part was validated already. So you can go through these processes, but so just to give you context, there's 21,000 different relevant permutations that come out of the neural net, as opposed to even a multivariate regression. It's nowhere near that number. So we can identify the top 1,000, the top 2,000, the top 10,000. We don't have to. So because there's 70 that are very, very powerfully predictive. And that is explainable to anybody that's in the trade, anybody that understands a mortgage. They'll get why these things are powerfully predictive.
Thank you. Any other questions or comments on this issue of adoption and data readiness or deployment? In the few minutes we have left, I'm just curious to set up a quick round of prognostication, crystal ball, and I'd be interested in hearing from our panel members where 2 or 3 years from now we might be sitting here talking about how, where specifically machine learning and artificial intelligence have transformed our industry in closing. Matt?
So I'll try and make it quick and keep it down to one thing. If there's one thing where I think we'll start to see the biggest impact, it's on servicing, or the flip side of servicing is portfolio management. So if you think about where ML has already made had a lot of success and where there's been a lot of iteration and a lot of proven value, it's in things like credit card fraud, where you can make predictions on short term and be able to look at and constantly add new data sets to continue to improve your predictions. There's much less, you don't have the same sort of hurdles in terms of proving your model to regulators if you're an investor and you're managing your portfolio and you're actively managing it the way that you think is best. And there is room for iteration. Every single month, your models can be making a prediction about, what the default rates are going to be, which particular loans are going to default, and you can be refining it over and over. So I think there are a lot of parallels between what they've been able to do in the credit card industry with servicing and fraud and things like that with ML models, and I think that's going to be something we'll see a lot more of.
I don't know what the equivalent of Moore's Law is for machine learning, but there will be this slow growth and adoption, and then a hockey stick will occur. And, you know, use the mortgage context. Digital mortgage that we all talk about is always been fiction and fantasy. In 5 years, I don't think it will be fiction and fantasy, or it will be something that many of the parts of the process have been ameliorated by machine learning. You'll be able to do, you know, the credit, the underwriting, the forecasting of the cash flows. You know, take DU or LP. You know, you may have models that are much more predictive than that. You may say, you know, and it may create a different secondary market. You know, there's many other things that can happen. So that's just my view. I think there's a lot that's going to happen in the next 5 years.
I guess, you know, my hope is that it just alleviates a lot of the inefficiencies in our market. I hope I have to do less grunt work because of these techniques. That would be great for me personally. You know, as people free up time from these manual tasks or inefficiencies, you know, hopefully that spurs more innovation in our industry generally. Maybe we can do other higher value thinking and a higher order of thinking things. So, you know, I agree with kind of all the things that Lester and Matt said. But really, you know, my hope is that it spurs innovation for the whole industry, because we have all these humans who now have brain power to apply to other newer and better things.
So for me, I would say agree and not agree with all of you and Lester. The big data and the platform in this industry definitely will help to grow this machine learning, especially to more and deeper to all different areas. But one thing I still feel the analytics space will probably both traditional modeling and machine learning will remain. I wouldn't really think machine learning will be the next generation for traditional model.
Great.
Okay.
All right, well, I want to thank my panel very much for their time and their knowledge and their expertise and their insights. And I will say, if there's any other comments or questions, we'll be happy to just entertain them right here. But seeing as how our time is up, we'll conclude the panel at this time. So thank you very much.